Hey, good evening, everyone. Good evening. How's
Good
everybody?
Evening,
good
Professor.
evening.
Good
Hey, good
evening.
evening. Hey, good evening. Good evening. All right. So,
Good evening.
good evening, Abani. I'm glad everyone is here. Um, so, as I made a pre-announcement, I made it. You remember, everyone is here because you saw the announcement. So we'll be meeting online this week, and this after this week is going to be spring break. So please read. Oh, no, not this one. This is not this class, but let me quickly check. Uh, Let me quickly look into the announcement. Right. So a couple of announcements, right? Um, oh, also about the special event on this Wednesday, right? So we're gonna meet um, at this meeting, right? It's a Zoom meeting. I believe it's a Zoom. Yeah, Zoom link is there. Uh, but before joining this meeting, you need to still do the same thing. You will need to go to basically, our discussion board and uh, sign in because this is not, I don't have any control over this meeting. So there's no way I can check who is present, who is not, right, in this Zoom meeting. So please, um, to make it count, to make your attendance count, you need to do the same thing. Always, go to our discussion board and sign in, right, as usual. So that's going to be this Wednesday. I hope. Then I hope to achieve. I'm hoping I can achieve something today, um, but it's kind of dragging on because as we do one example, this one example gets broken into. I mean, it cannot be. We've been working on this example since last class, but it couldn't be done. It couldn't be finished within the class. So it keeps repeating because it's a it cannot be just we cannot just jump into. We were all the way here, but then we cannot just pick it up from here because all the assumptions that were made before it, unless you remember it, there's no way we can keep going, right? So everything has to be repeated. So this example was about, uh, first, uh, this was about uh, finding weighted average cost of capital. But to do that, we need to first find the market value based capital structure. So probably you remember all of this up to that point. And then after we developed that, then we came to this. The market value of the debt is 2.365 million. Market value of the preferred stock is this. Market value of the common stock is this. Total capital, market value of the total capital is this. And then their capital structure, their weights are like this, right? And you should remember how we got to that. Um, but then next, to calculate, component cost of capital, we have to make some adjustments because cost of debt is benefiting from, cost of debt is the interest, right? But you are, part of the interest is benefiting from the tax shield, from the tax, right? Tax shield. We have to make adjustment for that. So cost of debt adjusted for tax, right? Because interest is tax deductible, right? And I don't let me go over this again. I went over this already, several times. Because interest is a business expense, and as such, right, you get you benefit from the you benefit from tax deduction, right? So you have to make adjustment to the cost of debt by as much as that interest, the tax rate. So we need to make adjustment to, and also we talked about the flotation cost. Flotation cost, again, if you're selling new stock, of course, if you don't sell new stock, if you don't have to sell new stock, no problem. This is irrelevant. But if you have to sell new stock, flotation cost is an issue. And I told you, flotation cost means, you have to make an announcement, first of all, right? If you're selling new stocks, you have to make an announcement. And then you have to print new shares, and you have to register those shares with the SEC, and but all that transaction cost and fees, right? That's all aggregated. That's all taken aggregated as flotation cost, right? As a big chunk. So cost of preferred stock, if you're selling new stocks, right? Cost of equity, a common stock, right? It needs to be adjusted for that. So this doesn't make, think about it, this doesn't make the cost more greater. It makes the cost, it doesn't make cost smaller. It makes the cost greater, right? It's just like, let's go to the cost of debt. So these two are, okay, these are two different examples, right? Because the market, this is weird. I mean, if they were to give, these can be two separate problems. But if I were to write this example, I would make them flow as one problem. In other words, this example 13.2 was solely for the capital structure based on the market value, and then making adjustment. They could make it, flow as the flow from the same example, but this is completely separate example now. So here, Blackstone Inc. has 12% coupon bonds outstanding that yield 8%. Blackstone, so 12% coupon, but the yield is 8%. So from this, you can tell, you can tell this is going to be a premium bond or discount bond. Can anybody tell me? Is this going to be a premium bond or discount bond? You should be able to tell just from the coupon rate and the yield. You should be able to tell whether it's going to be a premium bond or discount bond. Speak up. I heard, I a very, say that?
Premium.
Premium bond. Okay, who said that? Premium bond, who said it?
Ewa.
Awa. Okay, good. Awa. FNB230, right? Awa, you're getting 0.5 for that. Yes, it's a premium bond, right? The whole point is a simple rule of thumb is, since I can write on this, let me write on this. If okay, if the coupon rate is greater than the yield, then it's premium bond, and vice versa. What's going on here? And if it is the otherwise, if it is the other way around, then it's got to be a discount bond. Okay. But the question is not about, whether it's premium bond or discount bond. Blackstone's marginal tax rate, including the federal and state taxes, is 37%. So this means whatever, marginal tax rate means, we all understand what marginal tax rate, but why do they talk about marginal tax rate here? Because then we don't have to worry about whether, we will fall into the next tax bracket or current tax bracket, because as long as the marginal tax rate is stated as 37%, that's the tax rate. Okay, we don't have to worry about whether we're going to go into the next tax bracket or not. Now, first, notice that cost of debt is the current market yield of 8%. Yeah, that's the cost of debt, right? Yield is the so I don't know if I can move this, but can I? Maybe I can. No, I cannot move this. So I better. Okay. On the other hand, maybe I can write it up there. So all we need to do is adjust this by 1 minus tax rate. So calculate tax, 8% times 1 minus tax rate. So effectively, your cost of debt is 5%, 5.04%. Okay. And then next, cost of preferred stock. If you have to sell, right, the preferred stock of the Francis Corporation was issued several years ago, paying 6% of $100 par value. And float. So that means, the dividend. So 100. This is not the main point here, but you know how the preferred stock is valued, right? Preferred stock, price of the preferred stock. It's a perpetuity, and perpetuity is dividend over R, right? And then it's saying this is 6%. And at the time, this was at the time of the par value, right? Was this, and for this for that to be priced $100, the dividend should be, and we know how to calculate dividend then, right? This means, I wish there was an undo button here. There's no undo. So then, dividend is $6, that's obvious, right? Dividend is and that will give you exactly 6%. Paying, that's what it is saying. And a preferred stock is a perpetuity, and perpetuity is paying the same dividend, constant dividend, over and over, right? That's what the perpetuity is. Okay, I needed some fresh air. Now, so flotation costs on new preferred are expected. Now, what does this mean? Flotation cost on new preferred stock, right? So if you sell new preferred stock, right? If preferred stock is necessary to fund your to reach the target capital structure, right? You won't need to. Did I open a whiteboard? Now, why is selling preferred stock or selling bond is all? Why is it all? Why does it matter? I mean, why is it all coming up? It's because we are it's all because we are trying to reach a target capital structure, right? We are now, let's say, currently current capital structure is clearly different from right? Different from target capital structure. So if we want to reach the target capital structure, and of course to do that, if current capital structure is, let's say, 40% debt and 5% preferred stock and 55% equity, common stock. And what if the target capital structure is 35% debt, okay, let's do it. What if it is 30%? 30% debt, 10%. Nah, that won't be. Okay, still 10% preferred stock and 60% equity, right? And then think about it. Then you will need to, you don't need to sell new bonds anymore, right? You don't need to sell new bonds. In this case, you actually need to buy back bonds, right? To reduce this, change the capital structure this way. But this means you will need to sell more preferred stocks. So cost of cost of preferred stock is relevant question. Of course, then 1 minus flotation cost. And think about it. If we have to right, increase our equity from 55% to 60%, there are three ways. I mean, we can. There are three ways we can achieve this. One is, you can sell new stock, of course, but one is using, internally generated equity. I mean, if we, what is internally generated equity? It's profit. I mean, if the profit is basically equity because profit belongs to the owners, right? Shareholders. So by raising, if we can increase our equity through profit, right? Through EAT, right? Or that's retained earnings actually. Because from EAT you have to pay out dividends, but if you don't pay out dividends, it's fine. I mean, entire EAT will be retained earnings, right? And second way is, of course, by sell new stocks. What was the third? Selling new stocks. But what was the third one? It just And the flotation cost on new preferred stocks are expected to average 11%, right? Flotation cost, 11%. So then what is the cost of preferred if return on the similar issue is now 9%? So if the, think about it, 6% was when it was issued, right? If they were paying $6, then on the par value of $100, that's 6%. However, similar issues, similar preferred stocks, on average, they pay 9%. Then that means this is the discount rate. Okay, this is the discount rate. And calculate the cost to prefer if shares are selling at 75. Yeah, the price went down, definitely. At the time of the issue, when it was first issued, it was $100. Now it is selling at 75. So the price went down. And the 9% of $75 would be the dividends, right? But you can put it to later now, and basically the adjusted cost of preferred stock, well, 9% over 1 minus flotation cost. Okay, then it's going to be 10.1%. And if similar preferred stocks are paying 9% on the $75 price, right? And of course, the dividend payout, dividend on the preferred stock is constant. It's fixed. I've been telling you over and over. It's a perpetuity, meaning that it pays the same amount, constant amount, forever. I mean, if it is paying constant amount for a finite period of time, then that's annuity, right? But if it is paying it perpetually, right? Constant amount perpetually, right? Infinitely, that's perpetuity. So the dividend paid will be always $6, right? And the flotation cost, adjusted, for flotation cost, right? And current market price is 75. That will give you 9%, right? In other words, original cost of preferred stock, it will have to be 9%. Think about it. The math is basically the math is very simple. It's basically this. So this dividend is $6, right? And this is currently selling for 75, right? And the 1.4 flotation cost of 0.11, right? Whatever that R is, right? Then if we solve this for R, right? Then you'll get to 9%, right? So that's how you make adjustment to the cost of preferred stock. And cost of common stock is not precise due to the uncertainty of future cash flows. So market return on common stock is estimated by, there are three measures: CAPM, Golden Growth Model, or Constant Growth Model, risk premium method. And basically risk CAPM gives risk-adjusted return. But before CAPM, before Golden Growth Model, they used risk premium method. That was this was a pre-1950s method. Now there's pre-Gordon and pre-CAPM method. Okay. So think about it. Sources of new common equity, new common stock include retained earnings. I already talked about this. Newly sold stocks. Okay, so there are two, right? And then costs are different for each of them, because if you sell new stocks, obviously there's flotation cost. Retained earnings, you don't have flotation cost. But retained earnings are not free. It sounds like oh, it's your it's something that the company already has earned. So it's the profit in the company's coffer. Why can't it be for free? Because of the opportunity cost. Because of the opportunity cost. Think about it. Reinvested earnings belong to the stockholders. So stockholders could have spent it if paid as dividends. So think about it. Retained earnings. The company cannot just reinvest this for their capital structure readjustment, right? Why? Suppose you reinvest the retained earnings, and from that, or return on equity times 1 minus D, or that's called the same thing as plowback. 1 minus D is the dividend payout ratio. So 1 minus dividend payout is plowback. Okay. So return on equity times plowback ratio is the growth rate. Think about it. If this is greater than, think about it. You let the company reinvest, use this you let the company use the retained earnings for rearranging its capital structure. And then with the new capital structure, with the target capital structure, if the growth rate in the earnings, right, if the growth rate in the earnings is great, something like 20% growth rate from the growth rate of the earnings is 20%. Wonderful. Nobody will say no. No shareholder will say no. But if the this growth rate is greater than average market rate, wonderful. But what if this is like that? The growth rate of the earnings is less than even the average market rate. Then no stockholder will be happy for that decision. You understand? Stockholders are entitled to a return on these funds because this means there exists a cost to a retained earning as capital. Now think about it. I mean, you all understand shareholders are the owners of the company, but it doesn't mean shareholders get the earnings distributed. Profit isn't distributed to the shareholders, right? I've been telling you this over and over. Profit, if you want to reap that profit, you sell your shares, right? If Tesla has grown 20% over last year, year to year, right? If between March last year and March this year, over 1 year period, if Tesla has grown 25%, right? How do I know if it has grown 25%? It is reflected in the stock price. I know that without looking at their financial statements. I know that because the stock price, Tesla price that I hold is 25% higher. That is exactly reflecting. That's reflecting the earnings, right? EAT grew by 25%. In other words, you remember compared to equity at time zero, right? If equity at time one is greater than this, in other words, equity at time 0 times 1.25, if that is equity at time 1, that means this 25%, the only explanation is it came from EAT, right? So that 25%, that's a huge profit. Think about it. Original equity base, 25% of original equity base. So if Tesla wants to use this, retained earnings, and let's say Tesla hasn't paid out any dividends, then the entire EAT is the retained earnings, and they want to use this to increase their change their capital structure to and their capital structure will be new capital structure will be met by this, then they don't need to sell new stocks. They will use retained earnings. But then the question is, if they have been growing like 25% and no Tesla shareholder will be against it. But if Tesla's again, Tesla doesn't need to doesn't need to put it on the table for the stock board meeting, right? Board of directors meeting. But usually, yeah, board of directors will probably need to get board of directors will need to approve something like this because it affects the capital structure. But an individual shareholder, a minor shareholder like me, who has 2 shares of Tesla, unless you're a majority shareholder, you are not on the board. And if you're not on the board, you don't have any say in this matter. They won't ask you. But still, even if they won't ask you, you won't be happy. I mean, if by using this retained earnings, they will result in a very poor growth rate, the growth rate that is not even equal to the market return, then you'll be very unhappy about it. Board of directors will be very outspoken about it. Board of directors will be very, outspoken. What else can I say? Board of directors will be against it, right? That means for using retained earnings for adjusting the capital structure, it has to be the result of that capital structure, right? Result of the new capital structure should generate the growth rate, right, in the earnings that's greater than the average market return. Otherwise, right? So, however, no adjustment to the return on retained earnings is necessary, right, to calculate the cost of equity if you use retained earnings. Of course, payment to stockholders, that means dividend. Dividend is not tax deductible because it's paid out after taxes, right? From EAT. No new stocks are issued, so there's no flotation cost. Return on retained earnings, that's exactly then cost of equity. But however, if you sell new stocks, the cost of equity will be calculated. Okay, even if you don't sell new stock, basically cost of equity is calculated through 3 different ways. One, CAPM, the other one, Gordon model, and the third one, risk premium. And we all know from Finance 100, you learned what CAPM is. That means, return on stock X, right? Return on stock X. And return is cost of equity, right? And this equity is stock X, right? So so in other words, return on stock X is the return, a risk-free return, also called, also written this way, risk-free return. And so this is, return on stock X. And this is market return, average market return. And this is RF, risk-free return, times beta of X. No time to go over, so cost of X is the rate of return, required return on stock X, right? And risk-free return is, very short-term, riskless assets such as Treasury. You all know Treasury is the safest asset in the world, and very short term. I mean, 1 month, I mean, 1 year, that's okay. But even not even 1 year, 3 months, there's almost no uncertainty. No maturity risk. Okay, treasury bill, no default risk. And 3 months, that means no uncertainty related to time, no uncertainty associated with time. So that's no maturity risk. Okay. So the return on standard corporation stock is relatively volatile as reflected by the company's beta of 1.8. That's relatively high beta because beta of 1.8 means this stock is 1.8 times as volatile as the market. Return on S&P 500 is currently 12%. That's, average market return. That's 12%, right? Average market return. Beta 1.8. Treasury bill 6.5. 6.5, right? Risk-free return, right? Treasury bill as the risk-free return. Then, according to this, yes, this is, cost of equity if you're using return on equity. Okay. So this is the required return, and this is, of course, greater than, of course, market return, right? Because it has to be. It's 1.8 times more volatile than the market, so they require, right, higher return than the market. And no adjustment is needed because we are talking about using retained earnings. If we use Gordon growth model, this is, this is Gordon growth model. I normally use, S for price of the stock. This dividend at time 0. So Gordon growth model is usually, dividend at time t plus 1. Over R minus G. Now, this is dividend at time t, and if you multiply it by growth rate, then that's exactly, right? Dividend at time t plus 1. I don't need to write this, you should know. Right? But then our question is then, how do we isolate this? How do we isolate this? Well, we want to know this. This is our, of course, we can solve it, for, it's not a difficult math, right? So let me do it here. Where is it? Well, let's do it here. Everything that I write is like dividend at time 0 times 1 plus g. Or, we can, it can be rewritten as, you all know this is the same thing as dividend at time 1, but it doesn't matter. And r minus g, we want to find this, right? And what do? First, you will need to isolate. You'll need to isolate this term. To isolate, so it's going to be r minus, let me use, how do you isolate r minus g? Of course, s divided by right? Or D1, right? And then simply R, right? To isolate R. So this is not a difficult math. It's just, very basic algebra. Let me just call it D1, just to make it easier. Plus G. Okay. So cost of equity, right? Using retained earnings, right? Using golden growth model, you find it like this. Compare it with this. If you find it by CAPM, it comes to this. So if you use this, now, interesting thing is we cannot apply this to the same example, because in this example they never said anything about the dividend, and they never said anything about the growth rate, right? So we'll have to apply that to another example. Example 13.6. Periwinkle paid a dividend of $1.65 last year, and the stock is currently selling for $33.60 a share. Company is expected to grow at 7.5 indefinitely. Estimate, so growth rate is given, stock price is given, dividend is given. This is dividend at time 0, right? Dividend at time 0, right? Growth rate. So we can find dividend at time 1. Dividend at time 1 is $1.65 times. I'll have to so here we already know. Right? Dividend at time 1, right? This is dividend at time 1. Dividend at time 1, right? And then we come to this, right? So that's by golden growth model. Finally, using a risk premium approach, I said before that this is already, this is really rule of thumb. Because this was the days before, this was the method in the days before CAPM or golden growth model. So the relationship between the risks of debt and equity is fairly constant among firms. Incremental risk premium between cost of debt and cost of equity is similar for high risk and low risk firms. So the cost of equity can be estimated by adding 3 to 5%, 3 to 5 percentage points to cost of debt. So if the risk premium, so for the company that is, that has high risk, right? It's giving me a headache. And so middle of the road is 4%, right? So high risk, if the company is, please don't, let me have some undo button, please. Where is, so 3% is for, if the risk of that company is low, you use 3%. For high risk, 5% risk premium, right? So in this example, they used middle of the road, 4%. Carter Company's long-term bonds are currently yielding 12%. Estimate Carter's core cost of retained earnings using the middle of the road 4%. So they come to they came to this. Now, so this is really in a way I feel so rudimentary. So this is when they are using retained earnings as the source of equity. But if they sell new common stock, right? If they sell new common stock, that we will we'll need to make adjustment for flotation cost and etc. Okay, that we are out of time, so we're going to talk about it in the next class. Okay, of course, next class, if you attend that on Wednesday, because we're meeting in that special event, the next class will be after the spring break. So we're going to be so you need to at the time you should you should remember what we were doing, right? If you are if it is going to be a completely you're going to be if you're going to be a complete stranger to what we were doing, then I will be very, very disappointed. All right, so that's it for today. If you have any questions, please email me, because I have to make an observation right after this. So there won't be any time for questions. So please email me if you have any questions. Otherwise, please, schedule an appointment for my office hour. Okay. All righty. So that's it for today. Have a great evening, everyone. I will see you on Wednesday. All right.
Thank you, Professor.
All right. Take care, everyone.
Thank you.
All right. Take care.
Thank you.
All righty. Stop recording.